Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. We're talking about the market outlook and investing strategies for 2025. Matt, welcome back. Wonderful to have you with us today.
Yeah, thanks for having me back.
So the S&P 500 has surged almost 30% this year already, and the Nasdaq 100 is up almost 34%. And in fact, at the beginning of the year, most strategists were expecting positive but underwhelming gains for stocks. And I remember when we spoke in June about your second half outlook, many were still wondering whether the Fed can engineer a soft landing, but you said then that the soft landing has already transpired. And stocks have the potential to deliver impressive results in the second half of this year, and that turned out to be correct. And now 2024 is almost in the rear view mirror. So the big question for investors is whether stocks can continue to march higher, and that is after 2 years of blockbuster gains. But let's take a step back for a moment and reflect on the year so far. Did anything surprise you?
Well, I think, as you laid out, we were sort of spot on the ability for the Fed to engineer that soft landing, and then we sort of continue to carry on from that. I think for some people that was a surprise because there's always a concern of whether or not they'd engineer the soft landing. So the market's trajectory was not that large of a surprise overall. I think one of the surprising things has been just the significant dominance of U.S. equities that has continued to carry on. Because I think when we were heading into 2024, we thought that there might be some more escape velocity from international markets, particularly Europe, Japan, China, and so on. And what we have seen is that the U.S. just continues to go on another run of dominance from a returns perspective, where we're a few days away from the end of the year, but I think it's a pretty foregone conclusion that the U.S. will beat the rest of the world, and that'll be the 8th time in the last 10 years. And if you look on a rolling 10-year basis, using sort of monthly review periods, they've been beating the rest of the world on a rolling 10-year basis, basically since 2013. So a significant amount of time periods where the U.S. has just done well. And I think everyone keeps sort of predicting for when the international markets might catch up, but it's really sort of hard to predict that. And I think for most people this year, you continue to see the U.S. continue to do really quite well.
Right. So over the past couple of weeks, many strategists at some of the nation's biggest asset managers, including State Street and biggest banks, they have released their 2025 outlook. And one common theme that I have noticed in many of them is continued outperformance of U.S. stocks over their international peers. And as you mentioned, this has been happening for the past decade or so. Over the past decade, the S&P 500 index has surged almost 250%. And on the other hand, the MSCI ex-US index of large and mid-cap stocks, that has returned just about 59%, and this divergence just continues to widen. And I saw a very interesting note that you had put out, I think last week, about flows. And you mentioned that US investors are now they're just piling into US stock ETFs. And there was an interesting article in the Financial Times yesterday as well. And they pointed out that even European investors appear to be giving up on their stocks, and they are also piling into Europe-listed US equity ETFs. So that's really interesting. So you think that US stock market dominance can continue in 2025?
I think when we're looking at it, there are some tailwinds to the US market and US economy that investors may want to ride. And, predicting if the US will beat the rest of the world next year for the next 10 years is obviously something very hard to do. But I think we can look at what are some of the market trends and identify where in the US maybe you want to lean into. Because as you pointed out, if we look at the flows in November of 2024, 97% of equity flows went into US equity exposures, but they're basically large cap US equity exposures. So S&P 500 or total market where you have market cap weighted. So you're kind of making the same bet over and over and over again. You're just adding more concentrated risk to a handful of names into a sort of congested geographical position because you're just owning the largest U.S. stocks and keep doing that. I mean, it's sort of what the U.S. industry is all about. If you break it out by assets, roughly 64% of overall ETF assets in the U.S. are in U.S. equity exposures, and it's mainly large caps. But we think that if you do want to, own the U.S., there are some cyclical components that have some fiscal and also fundamental foundations that could be beneficial in a more near-term tactical sense in 2025, which would be something like small caps, which could benefit from a more domestically led agenda on the fiscal side, lower rates from a monetary policy perspective. And also, if we look at just earnings expectations, they are higher than the broader market in terms of the S&P 500. So small caps have a higher growth potential, but they also are coming at lower valuations because the market has been so concentrated over time. So, while, looking at past performance and saying, well, large caps might continue to run, that's sort of in the price, so to speak. And where you have some discounted future potential growth that represents some value, that's in the price as well for something like small caps.
So let's talk a little bit about your 2025 macro outlook. And you mentioned that rare soft landing. So what comes next after that soft landing in 2025?
Yeah, I mean, again, there hasn't been that significantly amount of soft landings to look at it and try to extrapolate past performance into future performance. If we look at the 1994 period where the Federal Reserve was able to engineer a soft landing, the U.S. economy, for instance, went on a phenomenal run of prosperity and the market returned a significant amount of gains to broad-based investors. And you had a well-functioning economy, labor market, and a lot of prosperity, as well as revolution in technology with the internet coming to age. I think there are some corollaries to 2025. If you think the technological innovation being AI, the labor market in the U.S. continues to remain quite healthy. Economic growth continues to be positive, and if we look at something like private sales to domestic purchasers, which is a good indication of business and personal consumption, that has been above the long-term historical rate for 7 consecutive quarters, for 4 consecutive quarters and above 2% for 7 consecutive quarters. So growth continues to remain positive, profits are positive. So I think where we are now is somewhat of a Goldilocks-ish type environment, which should be rewarding to risk assets. The only drawback would be the price. You're sort of paying a premium in the U.S. for this more abundant level of growth. And, the PE ratio right now, if we go back, over the last 40 years, is basically 2 standard deviations above the historical average. Perhaps given what we know for the rest of the world, where you have some lesser growth outside the U.S., more geopolitical instability from a political and also conflict perspective, perhaps the premium you're paying for more stable and resilient growth is worth the price. So I think where we go from here is it's more of a conducive environment for risk taking and to continue to own risk assets in this type of format because growth remains positive. But there are levels of uncertainty because you do have these dual track policies sort of staring down investors of evolving monetary policy, but also very uncertain fiscal policies. So how those risk assets will trend and trade will be dictated by headlines, but overall the fundamental foundations remain quite healthy.
So you mentioned some of the potential challenges, elevated valuations, and then policy uncertainty. Do you think there is a risk of resurgence of inflation as well, particularly if there are mass deportations or those tariffs that President-elect Trump has been talking about, those are implemented?
Yes, I think I'd rather think about it in this terms of that the trend of global disinflation or disinflation in the US is likely to be disrupted. So it wouldn't be high inflation. It would just be the slowing of inflationary pressures would no longer be in a more formal trend-like fashion that we have seen. And we've already started to see that play out a little bit. And again, we still haven't seen any of the fiscal policies be implemented, but you have seen a reduction in the amount of inflation or CPI numbers, slowing, right? So that we haven't had the same descent down that we saw in 2023 to 2024, where it was a very quick pace down the inflation mountain. I think we'll probably see more of a plateau instead of that sort of downward sloping move in inflation. And I think that is the ultimate risk, is that you will have more inflation surprises. So it wouldn't be high inflation, but inflation will be impacted by the fiscal policy uncertainty. And the market ultimately won't like that because it will result in some macro noise around those inflation prints. So I guess to put a finer point to the answer, I don't expect like this elevated, robust, nasty level of inflation, but I would expect to see that disinflationary trend be somewhat stunted if those fiscal policies do come to fruition.
Now let's talk about portfolio positioning for 2025. And you have some interesting themes in your note, in your outlook for 2025 and ETF implementation guides. So we talked about US stock market outperformance. And over the past couple of years, that outperformance has been driven mainly by tech exceptionalism, and that is thanks mainly to AI boom and NVIDIA, hyperscalers, and other infrastructure builders. They have been the early winners of the AI boom, and these massive investments that we have seen in AI infrastructure and cutting edge chips and models, they are paving the way for greater adoption. And in your note, you have this theme that we could see the broadening of AI value chain beyond the tech sector. Please talk to us about that.
Yeah, I think there's the near-term beneficiaries of AI, those hyperscalers, the large mega firms that are far and away over-investing in AI. But as those firms are over-investing and they're spending a lot of capital expenditures, there are firms down the value chain, in the supply chain, that are benefiting today, right? So they're not, this far and away futuristic endeavor where all of a sudden there might be a new product and service to deliver, from those hyperscalers in, say, 5 years that really revolutionize society. These are the firms that are supporting that overall ecosystem, that are supporting the infrastructure and the build out to have these transformational technologies. And I think those type of firms can benefit today as a result of those investment dollars to then offer a potentially sizable growth profile and partake alongside the revolutionary growth within AI across many different disciplines and across many different sectors. So that's something I think we're looking at today, because no matter what you think of the macro landscape and what you think of near-term policy risks or elevated valuations or regional differences of equity market performance, I think there's one undeniable sort of truth out there, is that, the AI revolution is real and it is impacting many different industries. And it is something very analogous to how the internet opened up many different avenues of growth and different avenues within our population to prosper as the economy evolves. So I think you need to look beyond just those hyperscalers, and you need to look more across different industries that are help supporting this growth of a new technology.
Now, another theme that you have, you recommend increasing cyclical exposures with domestic focused businesses. And you mentioned earlier that how Trump policies could help small cap stocks and other domestically focused companies. So could you expand and explain how these small caps and regional banks, they are poised to do well in 2025. So as far as small caps are concerned, we see that they outperform for a few days and then investors just go back to those mega cap, the max 7. So let's see if we can see this extended US small cap outperformance in 2025, which appears to be long overdue because small caps have been underperforming their large cap peers for over a decade now.
Yeah, I mean, just taking it back to some of those earlier comments, if we look at small caps, they have more attractive valuations than large caps. They have a higher projected growth profile than large caps for full year 2025 estimates. So fundamentally, you'd say that seems like a more valuable proposition to pile into or to own. I think then we look at it from a policy perspective, we do know that monetary policy is evolving where you have lower short-term rates, and small cap companies tend to have more floating rate debt or convertible debt from that perspective. So there could be a financing relief. They're more indebted, basically. So if you have lower rates, that could potentially improve their overall fundamental stability on a balance sheet perspective. But also from a fiscal lens, we do know that there will likely to be more nationalistic or protectionism policies out there. And that is going to lead towards a more domestically oriented economy. And that should benefit to more domestically oriented exposures like small caps. So you have those fundamental policies as well as fiscal and monetary policies as well, acting as some potential tailwinds for small cap equities that largely haven't been there over the last couple of years. And I think similarly on the regional bank side, just taking it from a policy perspective, there is the projection of lesser regulation. And if banks and regional banks are met with lesser onerous regulations around capital control, if that frees up their balance sheet to invest in other aspects of their operations that could have a positive return on equity or a positive return on invested capital, which is a big indicator of profitability for banks. I think also there is the valuation case to be made there. They do trade at attractive valuations. And then similarly, when we look at it on a growth profile perspective, if the economy continues to remain well behaved, you have lesser rates that should spur more lending. We do know that there could potentially be more M&A activity, IPO pipelines that should be benefiting capital market type exposures that are in M&A or investment banking, regional banks. So we do like the sort of broad-based financial industry as well, just from that perspective. So the last point there on banks is there also could be the potential, because of that evolving monetary policy, to have a steeper yield curve. You have lower rates on the short end, and then perhaps inflationary pressures from fiscal measures around tariffs lead to a higher rate on the long end, and a positive yield spread should be beneficial to net interest margins for banks as well. So there's a couple more arrows pointing up for regional banks post-election than there were pre-election.
Any other equity areas that you like for 2025 before we discuss the alternatives?
No, I think that's really it. So regionally, I think there's the tailwinds for the U.S. Again, in the near term, I think they continue to remain. Long term, over the next 10 years, that could be anybody's guess. I think no one knew in 2014 that the U.S. would be able to go on this phenomenal run, particularly what we were coming out of back then around different sovereign downgrade debates and debt ceilings and all that jazz. But when we look at it beneath the surface, we do like those, broader tech exposures, the transformational tech. We like the cyclicals. So those are the areas that we think can really add value in 2025, just given what the fundamentals say, but also the convergence of both evolving monetary policy and some fiscal policy that still remains largely uncertain.
Great. Now, you also recommend diversifying portfolios with alternatives. And in fact, we have seen that bonds are not providing the same diversification benefits to equities as in prior decades. And particularly, we saw in 2022, when stocks fell, bonds also fell. Bonds also had a terrible performance. So many investors are, in fact, considering reevaluating their 60-40 portfolio model, and many are looking at alternatives. So tell us about alternatives and why adding some alternatives to the portfolio makes sense now.
Yeah, it's funny. Like a 60-40 portfolio is actually not 60-40. It's usually going to be about 91-9 in terms of your risks, right? So if you look at a 60-40 portfolio, your contribution to risk from equities historically has been around like 91% of your volatility. So you're going to be very equity sensitive. You're going to inherit the boom bust profile of equities. And if we look at just how investors have been allocating, again, we'll go back to the ETF industry as a proxy for all portfolios. And I understand that it's not all portfolios, people invest differently, but it's a $10 trillion industry in the US. I think it's a fair proxy for what's going on. You have roughly about 64% in US equities. You have 15% in overall, 15% international equity exposures, and then 18% in bonds, and then a little bit of a mixture in the sort of other type of category. So you're very equity heavy. You're very U.S. equity heavy. And I know I just talked about, well, U.S. has been a good place to be. Yes, it's been a good place to be for the last 10 years, but I don't know what it would be like for the next 10 years. And I think also that outlook we have for the U.S., one of the last things I said in that last section was that those fiscal policies remain largely uncertain. And I think what we have seen is those headlines around fiscal have been quite frenetic. And I think when we also look across the globe, there's more political instability, particularly in France and South Korea, as well as Japan and Germany. There's other sort of political instability there around the ruling parties of control. So on the road ahead, you have a portfolio that is very risk sensitive, that is very equity sensitive. And if we look at the correlation between stocks and bonds, which again, that can change based on the movements of growth and inflation, which are the two main drivers of capital markets, they have been, stocks and bonds have been more correlated. And if we do get a growth scare at the same time we have an inflation scare, which occurred in 2022, bonds were not a diversifier. So you need to be more balanced. You need to be more environmentally balanced across different macro environments, as well as different volatility environments. So I think including alternatives, including things that have a low correlation to broad-based risk assets like equities, as well as having a low correlation to bonds, as well as having a positive relationship to inflation. So that's gold, commodities, real assets that could be beneficial on the road ahead, not just on a tactical basis, but on a long-term strategic basis, because the last 10 years are not going to be the same, or it's not going to sort of extrapolate itself to the next 10 years. Right. So I think investors want to take the time now and start to reevaluate their strategic portfolio allocations, because the market is only getting more uncertain every day, whether it's fiscal, monetary, or even from a geographical perspective. So that's why we like the gold, commodities, and other real assets and other diversifying strategies to help manage some drawdowns and just be more diversified in an environment where investors have been sidestepping the idea of diversification and just piling in to equities writ large.
Makes a lot of sense. Now, switching gears a little bit, I wanted to talk a little bit about an important milestone for the ETF industry. So last week, year-to-date flows into US-listed ETFs surpass $1 trillion. And I know that you track ETF flows very, very closely, so I would love to get your thoughts on that important milestone. And where do you see ETF flows by the end of this year and maybe next year?
So like you said, this year, $1 trillion in the US. We're actually $1.4 trillion globally, which is a record, $14 trillion in assets globally. And I think next year we'll likely see similar numbers, maybe even higher. And I think there's, this year, if we look at it, there are three secular drivers of the flows. You have low cost ETFs in the US taking in $500 billion, active ETFs in the US taking in $300 billion. Bond ETFs, which are, get benefits from the both of those, another $300 billion. So there's some secular drivers in the marketplace. I think is interesting, and it goes back to one of the original comments I had. This has been a more of a Goldilocks-ish environment. Stocks, bonds, commodities, the dollar are all up this year. Those four asset classes are all up this year. There's only been 2 times in the last 50 years that those 4 asset classes were up for 2 consecutive years. So what will 2025 hold? Not sure. But in 2024, amid this Goldilocks environment, ETFs took in $1.4 trillion. Mutual funds, US listed mutual funds. Again, if we use US listed ETFs, it's $1 trillion. So for a fair comparison, I'll say US listed mutual funds too. They have outflows. They have net outflows of 280 billion or so. So in an environment where Goldilocks has been the main character of this, this play or musical, if you will, ETFs have been the main choice for investors to deploy capital. I don't see that changing in 2025. And in fact, I actually see it accelerating. So one of the things that I think could happen, the Fed lowers rates. If we go back, look at some of the projections, they're looking for maybe a 3.75 rate by May of 2025. The last time we had a Fed funds rate of 3.75, US listed money market mutual funds were around 4.5 trillion. They're now at 7 trillion today. So if we round trip all the way to the 3.75 rate, that could be about 2.5 trillion that, again, could come out of money market mutual funds, which would make sense if the market has another strong year of returns, because you're in a money market mutual fund, you're going to be earning the cash rate, which is, again, probably around 4% on a weighted basis over the next couple of months. And that is not a valuable, attractive proposition when equities, bonds, stocks, commodities, everything has been up. So I think that outflow of money market mutual funds could add and accelerate the record flows that we have seen this year. And I think on a longer term basis, something that we wrote in July in our ETF impact report, where I made the prediction, and I think this year sort of reflects this trend. We were predicting globally that by 2034, there will be $43 trillion in assets in global ETFs, which would surpass global mutual fund assets. So I think we're on our way. I like the trajectory, and I think it continues to expand into 2025.
Amazing. So let's leave it there on that very positive note. But Matt, thank you so much for joining us today and for sharing your excellent insights. I really enjoyed our conversation.
Thank you.
That was Matt Bartolini from State Street. Now let's talk about some ETFs that you could use to implement the ideas that we discussed. So for broadening of the AI value chain beyond the Max 7, you could look at the Spider Technology ETF. XNTK is the ticker symbol. So XNTK, this holds 35 leading technology companies in equal weights, and therefore it avoids too much concentration in the Max 7, which have already surged a lot. It holds all those Max 7 companies, including NVIDIA, Apple, Tesla, everything. And another ETF that you could look at is the Direction NASDAQ 100 equal weighted ETF. So it is the equal weighted version of the QQQE ETF. Now, for small caps, State Street offers an excellent ETF, which I really like. It is the Spider Portfolio S&P 600 Small Cap ETF. The ticker symbol is SPSM. And I like this because this is ultra cheap with an expense ratio of just 3 basis points. And also, I like the small cap 600 index better than the Russell 2000 index, because Russell 2000 index has so many unprofitable companies. And if you look at the long-term performance, you will see that the small cap 600 index has done much better than the Russell 2000 index, mainly because of a profitability factor which is embedded in the S&P small cap 600 index. That is according to a study which was conducted by the S&P Dow Jones Indices. Now for gold, the Spider Gold Trust, GLD, it is the most popular gold ETF, but the Spider Gold mini shares ETF, the ticker symbol GLDM. So basically the mini version of GLD that is more suitable for long-term investors because of its just 10 basis points expense ratio. And another gold ETF that is suitable for long-term focused investors is IAUM by iShares Gold Trust, and this has an expense ratio of 9 basis points. GLD also ultra cheap, 10 basis points. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.